Welcome back to Factful Finance. Ever wondered how companies raise money to fuel their growth? It's not just about selling products or services, it's about securing capital. But how do they do that? Two words: corporate bonds and equity financing. Today, we're diving into their role in shaping the financial landscape and empowering businesses to scale and thrive. In financial economics, understanding the dynamics of corporate bonds and equity financing is essential. These tools allow businesses to tap into large sums of capital, each with its own advantages and trade-offs. Whether you're an investor, a business owner, or just a finance enthusiast, grasping how these financing methods work is crucial to understanding modern markets. But first, let me hit you with a quick reality check. According to the U.S. Bureau of Economic Analysis, private investments in businesses, both equity and debt, account for over 75% of the total capital raised in markets. These are not just numbers. They reflect how corporations structure their financing to grow, innovate, and adapt. Let's break this down. Corporate bonds and equity financing are both critical components of a company's capital structure. The main difference? Risk and ownership. Corporate bonds are essentially loans taken by companies. When you buy a bond, you're lending money to the company in exchange for interest and a promise to pay back the principal at a future date. Think of bonds as a safer bet for investors, but with the trade-off of limited growth potential. Bonds don't offer you any ownership in the company, and while they provide steady returns, they don't allow you to share in the upside if the company booms. On the other hand, equity financing involves selling ownership stakes in the company through stocks. When you buy a share, you become a partial owner of that company. This means you're in the driver's seat when it comes to potential profits, but it also means you're exposed to risk. If the company does well, your stock price goes up. But if things go south, you could lose money. So, why do companies choose one over the other? It's all about balancing risk and reward. Let's imagine Olivia, a tech startup founder. She's seeking $5 million to scale her company. She has two choices: issue bonds or sell shares. If she opts for bonds, her company avoids diluting ownership, meaning she retains control. However, she'll need to pay interest, and if the company doesn't perform well, the bondholders still get paid. Alternatively, if Olivia sells equity, she can raise the funds without any immediate debt obligations, but now she has to share decision-making power with her new investors. Both options have their merits. Bonds give companies access to capital while preserving ownership, but the repayment terms can be burdensome. Equity financing offers flexibility without the weight of debt, but it comes at the cost of ownership dilution. When we zoom out to the broader economy, these financial instruments play a vital role in keeping markets liquid and businesses moving forward. For example, during the 2008 financial crisis, companies that had strong bond programs could tap into funding when traditional bank loans were no longer available. Similarly, equity financing helped companies like Facebook to raise funds and grow rapidly while attracting millions of investors looking to share in the company's success. Let's not forget the investors. If you're a bondholder, your priority is steady returns. Bonds can be attractive for those seeking stable income streams. But equity investors, they're in it for the long haul, betting on a company's success. The potential for high returns comes with the higher risk of volatility, which can be both thrilling and terrifying. This all ties back to what corporate finance is really about: managing risk. A well-balanced portfolio of both debt and equity can help companies and investors navigate uncertainties in the market. Now, how can you as an individual make the most out of understanding these tools? If you're looking to grow your wealth, bonds can offer security and a reliable income stream. But if you're willing to take on more risk for the possibility of higher returns, equity investments might be your path to success. Just remember, never invest more than you're willing to lose. And diversify. 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 If you're ready to apply these insights to your own portfolio, I'd recommend speaking to a certified financial planner, CFP, to tailor a strategy specific to your goals. As always, this content is for educational purposes only. Mentioning any apps, products, or services is not an endorsement. Always consult a certified financial professional for personalized guidance. So how does this all connect to the bigger picture? Think of corporate bonds and equity financing as the lifeblood of corporate growth and market efficiency. They help companies innovate, expand, and meet their strategic objectives while offering investors various ways to participate in the potential rewards or risks. What's the biggest takeaway here? You can't just focus on one. Both bonds and equity financing have their place in a company's toolkit and in your investment strategy. If you want to learn how to use these to your advantage, keep up with Factful Finance for more in-depth financial insights. Which financing method would you choose if you were a business owner? Or if you're an investor, do you prefer bonds over stocks? Drop your thoughts in the comments below. I respond to as many as I can. And hey, if you found this valuable, you're going to love what's coming next. Keep watching for more expert insights. Click the video on screen now.